What is going on, traders? Welcome back to the Traveling Trader. I'm going to be telling you why the stock market could be going crazy soon. Obviously, the direction will depend on the outcome of some of these factors that I'm going to discuss, and whether you should be buying stocks now. Is the market presenting us with a perfect opportunity to buy? As you know, we only dive into empirical and objective data on this channel, and we try to make the best decisions and the most informed or educated decisions based off of that. If you've been following the trends that we focused on this channel, you know that the September-October downtrend is so far playing out exactly like it has been the last 23 years, with September 17th being the date that stocks started the downtrend. However, we have two very fun and pleasant additional things to focus on this year. One, supply chain disruptions. Two is inflation, which is partially caused by the supply chain disruptions. Now, earnings season is just beginning, with a few mega cap companies reporting earnings this week as of the time of this recording, and the rest will be reporting in the next 2 to 3 weeks. Financial analyst Lindsay Bell was on CNBC this morning, and she gave us a good indication of how the market usually performs during Q3 earnings season, which is the one that we are going through right now. Let's take a listen.
This chart showing the S&P's performance on average going back to 2000 for each earnings season of the year, all four of them, and surprisingly Q3 is the standout here. What can we take away from this work that you've done?
Well, the third quarter, you usually do see stocks react well to earnings season. We're starting to think about the end of the year and into next year, and you start to hear corporate management teams talk about that. So that gets investors revved up about what's yet to come. Now, when I think about this third quarter earnings season, what's interesting this time around is this is the first quarter in 4 quarters that we're actually seeing earnings estimates move a little bit lower into the reporting period. At the same time, we've also seen the market move lower going into the reporting period. We haven't seen that for a good 4 or 5 quarters. So the setup looks good for stocks to perform well on the back of earnings. But really, it's all going to come down to the commentary about margins and pricing power.
All right, so if you take a look at the data that she presented earlier, she said that the S&P 500 average change by earnings season since 2000, so going back 21 years, this mid-October to late November period usually poses a 2.5% incline in the S&P 500. Now, this correlates with that data that I brought up a month ago now, talking about the trend, the September-October trend, and when we can expect stocks to come back, which was during the second to third week of October. Now, a breaking news story just came out as of the time of this recording, saying that the IMF cuts global growth forecast, citing supply disruptions and the pandemic. They also expressed their concern on inflation and stated that monetary banks will likely have to tighten up policy soon. And as I stated before, one of my main fears with this earnings season is that we start a decline, that September decline that I was talking about, leading into earnings season, but because of supply chain disruptions and inflation, we will actually see what's called demand destruction in the market, where even though demand was high at one point, the fact that consumers cannot get access to products will actually cause demand to blow up and hence lead to lower earnings, which will give the market a shock that, hey, we thought after the pandemic that the economy would be roaring, GDP would be roaring, consumer behavior would actually be elevated, but we are now seeing companies report less earnings than they did the previous quarter, which will be an objective indication that the economy could be slowing down due to those issues that I discussed. Now, if that's the case and over the next month the market continues down further and inflation gets out of control, well then Papa J. Powell will have to either raise rates or taper or both, which will likely cause a further shock in the market. This is why I continue to maintain hedges going into this earnings season. We have a hedge on the VIX. We sold a put spread at the 18.19 strike price. We're up 20% on that. We have a neutral trade on Tesla, banking it to finish between 735 and 845 leading into next earnings. Because of the slight increase in volatility, we actually got a decent premium for the spread. However, we did keep a wide range because of the current market conditions. And I personally also have a collar spread on the SPY. I went over how to hedge in this video here. If you want access to all of our trades, all of our hedges, options, stocks, crypto, etc., link is in the description below. Just for shits and giggles, I even entered a trade on SHIB, made 105% on that on 10x leverage. But again, sign up if you want access to our wonderful community of over 4,000 traders. All right, so In conclusion, what I'm going to say is this. Even though the second to third week of October is usually when we see a turnaround, if you are a diligent dollar cost averager, meaning if you're the type to buy regularly into the market regardless of the price, I feel like you can continue doing so here. This is not financial advice. This is just my opinion. But I do like to utilize what's called a weighted dollar cost average strategy, meaning that if something like the SPY or the NASDAQ is at the 100-day moving average, then you average in a little bit more. It's not a regular buy because that is a major moving average. However, I feel like if you are a prudent trader or investor and you've been waiting with cash on the side, you can actually wait a little bit more until a few more of these earnings on mega cap companies come out, because then you can use that as a gauge to see how company stock behaves on future earnings announcements. Because the worst 1-2 punch combo that can happen is that the market continues to drop due to bad earnings caused by inflation and supply chain constraints, and the Fed actually tightening up policy at the same time. We could get a shock to the market. Now, if that happens and we see the market fall to the 200-day moving average or 300-day moving average, that will be one of the biggest buying opportunities since the 2020 crash, and before that, since the 2008 crash. In terms of what stocks to buy, I talked about the barbell approach in this video here. But if you are going to do buying here, you will want to include some real assets in your portfolio, like Michael Burry. This includes metals, land, water, equipment, etc. There's also a very bullish case to be made for travel hospitality stocks because those don't really rely on supply chains in the same way that retail products do. You obviously want to hedge your portfolio. Again, go back and watch that video. And the other end of that barbell is going to be mega cap growth stocks. You can just really take your pick of any of the mega cap tech stocks, or you can buy into the QQQ, which tracks the NASDAQ, or the TQQQ, which is the leveraged ETF that tracks the NASDAQ. I would also look at bank stocks if interest rates are going to rise. Anyway, traders, that is it for this video. If you got anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of the current market landscape and what you're trading. Sign up if you want access to all of our trades. Link is in the description below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.